Well, we have your market news now. Asian shares were mixed while oil prices slid to 6-month lows as traders waited for the year's final policy decision from the Federal Reserve and clues on whether the central bank will cut rates in 2024. In Asia, in China, blue chip stocks fell nearly 0.5%, while Hong Kong's Hang Seng Index slid 0.8% as investors continue to look for clues for further policy support from Beijing. In local news, thermal coal exporter Thungela Resources said it expects a 7.6% decline in production from its South African operations after curbing output due to persistent freight rail problems. The rail crisis blamed on a lack of locomotives and spares, as well as cable theft and vandalism, has forced other bulk mineral exporters such as Kumba Iron Ore to cut production due to constrained capacity to transport commodities via rail to port. To give us more perspective on the markets, we are joined by Ricardo Smith, who's the Chief Investment Officer at SABC Investments. Ricardo, thank you so much for your time. So let's look at what's driving markets ahead of that all-important final FOMC meeting for the year.
Afternoon, Nastasha. No, certainly, I think that is the main driver of markets at the moment. The Fed does tend to drive the conversation around interest rates. And so locally, we are seeing that having an impact. A bit of sideways movement in our markets. The rand weaker slightly as we see foreigners, net sellers of South African equities. And the anticipation is that, those rates will be flat. And so money are flowing a bit to U.S. markets.
So, we're expecting Fed Chair Powell to leave rates unchanged. But in terms of key messages here, what are you going to be listening out for?
I think the tone of the message and whether there's a change in terms of some of the previous communications, which was that, they do believe that rates are sufficiently high to contain inflation. So looking to see whether that view changes. And also, the Fed expectations in terms of when they see rates starting to be cut. That will be quite significant. Don't want to see reviews further outwards, and I think markets will be quite sensitive to that.
Yesterday, we had a conversation looking at who is likely to lower rates first, whether it would be the Federal Reserve or the European Central Bank. And it was quite interesting to sort of glean some responses from the analysts. From your perspective, who do you think is likely to move first?
I would put my money on the US Fed. I think, front-loading interest rates, being a bit aggressive, giving those 75 basis points and getting them in the system, as there is a lag to when they have an impact, does seem to have paid off. And so I would anticipate, the Fed. And further, I think the ECB, there is a complexity with managing monetary policy across multiple economies. But having said that, there is, the risk that the ECB does find itself in a corner with some of the economies struggling with where interest rates are. But, I would definitely lean more towards the Fed. Though it is worth noting that the Bank of England was ahead of the Fed in terms of the rate hikes, and so was the MPC locally.
As the Chief Investment Officer at SABC Investments, I'm curious, if you were to look back at the past couple of months or so, have you picked up any contradictions in the markets?
Yeah, I think, when we entered the year, there was, a lot of negativity around and negative market sentiment. But, U.S. markets have done quite well, and so have global markets. And we were quite, convicted that we would see some market recovery from the U.S. given the drawdowns last year. Although, the macro picture and the geopolitical tensions and the policy changes have not been accommodative, we think that, entering the year, valuations definitely were quite attractive. And I think we've benefited from that. There are some contradictions, I think, going into next year. The ideas of whether we see a soft landing from an economic growth perspective, and whether we see that recession, and what will be the catalyst to the Fed cutting rates. So we think that the cutting of rates will obviously spur market prices higher, but balanced against those fears of a recession. So there's a bit of a contradiction there going into next year, and I think valuations not as attractive as they were at the start of the year, but long term still a bit attractive.
We've kicked off the festive season, and when it comes to consumer spending locally, what's more important to you? Is it how much consumers are spending or how they are spending?
I think both is important. Definitely would want to see consumer spending, and in the latest GDP print, we saw household consumption expenditure coming in negative. We have seen as well with a lot of the banks, some impairment revisions, and within the retail sector as well, we've seen some of the stores that facilitate sales through credit doing well as the spending was ramping up. But we have seen, some negative impairment revisions. So do want to see spending, but want to see healthy spending, want to see healthy balance sheets, healthy liquidity. Don't want to see impairments deteriorating too aggressively. And, I think also just, separating in terms of new sales and inflationary growth in sales from the different stores, and some of the different strategies around traffic density within the different stores, and how that is unlocked going forward. So I think both are important. Want to see spending, but want to see healthy spending as well that is sustainable.
Let's leave it there, Ricardo. Thank you so much for your time. That is Ricardo Smith, who is the Chief Investment Officer at ABSA Investments. And as I mentioned, we've got that all-important final Fed policy meeting for the year. Economists are expecting Chair Powell to leave rates unchanged. However, as I mentioned, the important thing is going to be the dot plot. And what we're going to be looking for here is how much that dot plot deviates from market expectations, which is already pricing in 100 basis points of cuts. We'll also be looking at the summary of economic predictions, and the last time that we did receive both the dot plot and the summary was back in September. However, we're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.